Hey, good afternoon, everyone. Marty Mazzora here, Friday, 27th of January, 2023, with your end of week stock market snapshot. I will circle back this evening or sometime over the weekend with your weekly economic update. So we're going to separate them today. In front of you is QQQ, the index, or I'm sorry, the ETF that tracks the NASDAQ 100 index. I want to start there today. So we'll look at the hourly and the daily there, and then we'll look at the S&P 500. A few things I want to talk at you about today. Just to open it up, regular viewers and clients, you know that I am short-term bearish equities, global equities even, longer term, maybe even intermediate to longer term, bullish global equities in particular, and bullish many of the commodities and so on. So our short-term bearishness should be put into context if it turns out to be the right position. It is not anything end of the world-ish. We are in the recession camp, as I'll express later today or over the weekend. We do see it as being a mild recession taking place in 2023. We think officially sometime in the first half. We think the recession, though, will be reflected in corporate earnings that aren't, I want to say, nearly discounted yet in stock prices for a variety of reasons, we think. And we think that that accurate reflection in multiples, in valuations, means a somewhat notably lower level for the S&P here before this thing finally shakes out. None of this has to happen that way. That's our view of the evidence and what it speaks to us about probabilities. If you want to just put it simply, we just are not comfortable with the near-term go-forward risk-reward setup. As I keep saying, doesn't mean that our concerns could come to fruition. It just means our concerns, we believe, are very valid and therefore demand that we continue to hedge portfolios, we continue to keep our dry powder, we continue not to allocate much of, if any, of the new money that's come in to allocate, that sort of thing. Now, the market's telling a different story, as you've no doubt noticed, and as we've addressed here. Stocks just continue to melt higher. I've alluded to over the past year plus the dynamics under the surface that have to do with options in a somewhat speculative manner, also the hedging that goes on, and the influence that dealers, as they hedge the other side of those positions, have in the marketplace. We've talked about that a lot the last quite a few months. Today, apparently, there's a phenomenon that's happening under the surface at the extreme, and it's these 0-day to expiration options. Primarily call options of late have been coming in intraday, so people are literally day trading the market on the long side and coming in aggressively at certain levels at certain times of day and really pounding this market higher. And again, there's that underlying hedging that needs to be done by the dealers, although it's of a very short-term nature. So all evidence says that this market has some very, very short-term support for it that is not really anything that's fundamentally based. It's just a speculative tact that's been working quite profitably for the bulls who have timed it well in there. Now, what that suggests, though, is that there's, for lack of a better term, perhaps some artificial support under this market that should it go away, it's probably a when. I don't know when, but when this goes away, unless there's another force underneath it that is resoundingly positive for equities, then, of course, by definition, if it's support that goes away, well, then that leads to the greater potential for something more precipitous to the downside. And of course, this kinds of option action, if it were to flip and suddenly it made sense to go long puts, if that sentiment and the elements that are behind that sentiment were to change on a near-term basis, then of course you could have something somewhat artificial that would exacerbate downside moves. So again, fundamentally, if you will, when we look at things like how earnings are showing up, the underlying inflation today, for example, and I'll probably get into more of this when I do the economic update, Personal consumption expenditure data came out. Personal income was just pretty much bang on consensus expectations. It was up 0.2% month over month. That was the consensus among economists. Personal consumption expenditures, what people are spending. The consensus there was it would be going down by 0.1%. It actually went down 0.2%, so it was double what was expected. That's consistent with our weakening recession thesis. Prices, the deflator, the PCE price index went up 0.1% month over month. The consensus was 0.0, so inflation on a month over month basis was a little bit elevated there. On a year over year basis, which of course is hugely impacted by base effects, 5.0% was the number, 5.0% was the consensus. When we take out food and energy and get to the core deflator, 0.3% was the consensus move higher month over month. That's what we got. 0.3, 4.4 year over year. 4.4 was exactly what we got. On a year over year basis, that's down from 4.7, but on a month on month basis, it's up from 0.2% last month. We have a long-term structural view on inflation that says it will be higher long term going forward, and we're talking multiple years versus what we've experienced the last 40 years or so. But during cyclical downturns, inflation will go away and it'll drop below the Fed 2% target. And the question is, is that sustainable? We think the answer is no. So that makes for an entirely different setup for equities going forward, U.S. equities in particular. In the short run, it appears to us and to others that there's some underlying factors that are painting a picture that may be a little more robust or a little more bullish than deserves to be painted, which makes for some potential dangerous downside moves as we move forward. Next week, we get the likes of Amazon and Apple. Those are big earnings releases, of course, hugely influential on the overall market. So short-term traders, if there's any of you out there who are watching my videos, you got to walk softly here if you're short the market or if you're bearish like we are near term. This can come up and bite you. I mean, I mentioned the other day that the trends looked pretty bearish on a short-term basis, but I actually mentioned Tesla, and I said Tesla, the next day, which was Thursday, if they come out and have earnings that the market likes, well then, the Qs, the Nasdaq 100, the Nasdaq, the market itself is going to shoot higher. Tesla's literally up 12% today as I talk at you. So that's in there as well, and I'm sure some of that short-term call buying is happening there as well. Okay, so let's jump into the technicals. Here is the QQQ again. It's the ETF that tracks the Nasdaq 100 index, and folks, I got to tell you, this is simply a bearish look. You've got your rising wedge pattern, and I'll say on the RSI for sure, that would be a negative or a bearish divergence. On net, it is really looks suspect of rolling over in potentially a not small way. But remember, I mentioned, a couple of stocks that are about to report earnings that are very influential on this index. And if they come in hot or they come in above expectations, we can blow right through these divergences and continue to melt a bit higher. As I said on Wednesday, and as I'll probably say again when we get to the daily charts, the conviction here from a technical perspective, I think on my part, needs to be pulled back a little bit because we are now frequently pounding against resistance. And right now, as I speak so far today, actually, breaking through it to the upside. Now, I do think there are factors in play that are influencing that could quickly be reversed, but nevertheless, it is what the charts are showing us. Let's take a look at the daily. For the Qs, we have had this downtrend line just like on the S&P 500. Let me back up here to make sure we capture the whole thing. And that's the red line. That's the red line that comes from the top back when the market peaked all the way down to where we are today. Drew a yellow line here that takes us to this year, the 2023 high, and draws that forward, which gives us another trend line that's had more room to go. But as you can see, as I speak at you again here today, the NASDAQ is above even that trend line, and that trend line, see the blue right here, literally lays right on top of the 200-day moving average. So right now on the daily chart, we have a breakout above the 200-day moving average above both of these trend lines, if you will, right at where we had a double top right here in December of last year. And we're reaching, again, even on the daily now, we're basically bumping on what you would call overbought territory. And when we look back here, right, we had overbought here. We had a MACD that actually was giving us, not bearish signals. In fact, that would have been a bullish divergence right in here. But when we got overbought, sellers came in against these resistance lines right here, 2, potentially 3 layers, and that was pretty much all she wrote. Right here, almost got there, right? Against, again, pretty good technicals other than the, not as good as here, but other than the overbought level on the daily. And here we are today, folks, as overbought than we've been all year. So if earnings don't come in good for these big NASDAQ components, you could see quite the avalanche of selling. In bear markets, failed breakouts are pretty much the norm if indeed we're not ready to mount, our way into the next bull market, and that still remains our base case. As for the S&P 500, the daily chart, pardon the busyness here. I have to clean this up at some point, but I want to keep all this on here because these are good conversation points as we work our way back. So like I said the other day, when we had these hits of major resistance, okay, here's the top, came back, established that trend line, right? And it was just something that basically got hit. The technicals all rolled over and, we were significantly lower. Here we are, lower low, lower low, lower low, lower low. And remember back in here, this was the target we actually set for the entirety of the bear market. But back in here, our assessment was that we weren't about to enter a recession as it is today. And I said back then, if we do get into a situation where recession odds are greater than continued expansion odds, and that's what we see today, then we're going to have to bring this target lower because the first leg of this will just reflect higher interest rates and consequently lower stock multiples. Ultimately, as earnings roll over and that gets discounted, we get to lower levels. And right now we're thinking 3,200 makes a lot of sense if our thesis plays itself out. But we came bounding off of that. Remember, folks, we got very short-term bullish right in here as we did at 3,800. Okay. And here, here's where I'm talking about. We keep hitting our head against this. So again, failed at the downtrend line, but above the 200-day moving average, above the 200-day moving average, and at the downtrend line. This go around, we pierced the 200-day moving average and the downtrend line, and now we're threatening this level right here, which just back to that double top. And we're not going to get there without a negative divergence in terms of the slope of the MACD. We won't have a negative divergence on the RSI if we get there right away. Okay. And remember down in here when we were consolidating, we were telling you that this looks pretty bullish to us, at least from in terms of what the momentum indicators are signaling. Now, thinking a little further under the surface, or maybe a lot further under the surface, we've been looking at on balance volume off and on. I don't know what's happening to my lines here, but in fact, let me pause for a second here and I'll fix them. There we go. So for quite some time now, all the way pretty much back to here, although we had a bullish divergence here on balance volume. So people were accumulating there. They were in accumulation mode is what this essentially denotes. But then as we ramped higher, when we hit these levels right in here, the bigger volume was on the down days, which suggests that folks are using the rallies to get out of Dodge, so to speak. Then we came up and tested that with a really ramp lower in the daily on balance volume, right? Even while this was consolidating and while the technicals in terms of momentum indicators were pointing bullish, maybe thinking longer term and bigger picture, on balance volume was declining. Now this last really, I'll call it aggressive ramp higher, on balance volume has been rolling over. So the way you would interpret this is that folks are using these rallies, maybe exploiting what's going on in the short-term options market to continue to scale out of this market probably anticipating the lower earnings setup that we're beginning to see and we think is going to perhaps accelerate as we get further into earnings season. But we'll see. That doesn't have to happen that way, but that's what the whole macro setup would suggest. So we do have our, again, our rising wedge pattern right in here. And as I showed you on the momentum indicators, we have things that still look suspect just from a pure technical perspective. However, remember, we have this reverse head and shoulders, right? That's what that is, folks. And this is the neckline. And what have I been telling you? If we break through that neckline with some momentum and really accelerate, particularly up through, say, 4,100 on the S&P, um, and with some momentum, and we just come down and test that neckline and bounce, technically, we're going to have to start telling you a more bullish story. We'll also tell you the fundamental story, but we shall see. Right now, I will be surprised if we get to that point, but I'm very open to that. One thing that we're promised not to be here is just not to be bearish or bullish, say for our own purposes or because we want to be right. Happy to be wrong. Every day we're trying to find evidence that we're wrong because, we manage other people's money. So the job is here is to do it right and to do it consistent with what we see as the right risk reward setup. And again, we think the risk reward setup is precarious right here. It's not that we're not long a bunch of stuff. We are because we have a longer term outlook. And it's not that we're not up very nicely so far this year. We are because of our long positions. We just will not be surprised if we don't give up a good chunk of that, but we're hedging in a way that we think will mitigate something extreme if we did get the ice breaking and a big waterfall sell-off, which we think is potentially in this market right here. So that's why we do the hedging and so forth. It doesn't keep us from going down in a sell-off, but it can protect us from something severe to the downside. So much of it rests with what the Fed thinks of these now somewhat easy financial conditions against what they promised they would do. These inflation prints that seem to be holding in there, relatively elevated and so forth. So next week, February 1st, is a Fed meeting. Could be a lot of fireworks then. Big week for earnings next week. Next Friday, we'll get the January jobs number. So take care, you short-term traders out there, clients. Of course, this short-term stuff is instructive to us in terms of timing of putting new cash to work, that sort of thing as well. When we look out, we've got fundamental reasons to be concerned, particularly through the first half of this year. Fundamental reasons, globally speaking, to get very bullish beyond what we still think is more shaking out of the current bear market. And equities, commodities are another story that we'll be getting into, mostly on the written blog probably, but we'll do the technicals here as well. I tend to jump into commodities when I do the economic updates. I'll leave it there. Thank you for hanging in there on this relatively long one. Be back within the next few hours with your weekly economic update. Thanks as always for watching and listening. Take care. Bye-bye.